And I would say that is an alternative, for example, that my successor may wish to employ, because on balance I would rather own an index fund than carry treasury bills. I would say that if we'd instituted that policy in 2007 or 8, we might have been in a different position in terms of our ability to move late in 2008 or 2009. So it has certain execution problems with hundreds of billions of dollars than it does if you were having a similar policy with $1 billion or $2 billion or something of the sort. But it's perfectly rational observation, and certainly looking back on 10 years of a bull market, it really jumps out at you. But I would argue that if you're working smaller numbers, it would make a lot of sense, and if we're working with large numbers, it might well make sense in the future.
So dollar averaging is a good way, if you have a lump sum to invest, to make sure you're going to do some kind of, like, spread it out over 4 years, do it every quarter, something like that, 5 years, and that's a conservative idea.
I think the more powerful part of dollar cost averaging really is just every year setting aside money and putting it in.
Well, sure it is, and that kind of option that I just described is not available if you don't have the $1 million.
Right.
So you're starting off, and when stock prices go way up, you're happy. You think, boy, have I been smart here? But you should be sad if stock prices go way down in your, let's say, 6th year of investing. Well, all of a sudden, you're getting more shares for each dollar you invest. So it's a way of eliminating, to the maximum extent possible, the vagaries of the stock market, which in the short term do things for no explainable reason, except the stupidity or hope and fear and greed of investors, all those emotions that get into the game. So dollar cost averaging, absolutely yes, under those circumstances, and those circumstances are the circumstances that will apply to probably 95% of all investors.
People that have joined me because they think it's a permanent home, to do that simply because somebody waves a big check at me would be like selling one of my children because somebody waved a big check. So I won't do that. And I want to tell my partners I won't do it so that they're not disappointed in me. More and more, with certain stocks, we've got that approach. Now, if we were chronically short of funds and had all kinds of opportunities coming, we might have a somewhat different approach. But our inclination is not to sell things unless we get really discouraged perhaps with the management, or we think the economic characteristics of the business change in a big way. I mean, and that happens. So, but we're not going to sell simply because it looks too high, in all likelihood. I mean, you can't make that 100%, but that's the principle under which we're operating. We're generating right now $5 billion of cash a year at least, so it's $100 million every week, and just not. We've been talking here half an hour, and I haven't done a damn thing. It's, the real question is how do you put it out intelligently? And if we were selling things, it'd be just that much more. So there may come a time when that would change. But we want to, and I have partners, shareholders, partners, who would say, if you can get 3 times what See's Candy's worth, why don't you sell it? And that's why I want to be sure before they come in, they know how I think on that. I mean, they're entitled to know that.
We can go down. When I ran Magellan, 13 years, it declined 10% or more, 9 times the market.
Wow.
I had a perfect record. I went down more than 10% every time. Wherever the market went down, I went down more. But over the long term, the upside is more than the downside. So you got to say to yourself, do I need the money in the next month? Do I need the money in the next year? Do I have kids going to college? Do I have a wedding coming up? Then you're a bad investor. If you can keep putting money in, you have 5, 10, 15, 20, 25 year, you should do well.
My name is Ted Friedman. I'm from Cincinnati, Ohio. You said in the 1996 annual report that most investors will find that the best way to own common stocks is in an index fund that charges minimal fees. 2 questions. First, there are a lot of different index funds that hold different baskets of stocks. what criteria would you use or recommend to select an appropriate index fund?
Yeah, I would say that in terms of the index fund, I would just take a very broad index. I would take the S&P 500 as long as I wasn't putting all my money in at one time. If I were going to put money into a index fund in relatively equal amounts over a 20 or 30-year period, I would pick a fund, and I know Vanguard has very low costs. I'm sure there are a whole bunch of others that do. I just haven't looked at the field. But I would be very careful about the costs involved. Because all they're doing for you is buying that index. I think that the people who buy those index funds on average will get better results than the people that buy funds that have higher costs attached to them, because it's just a matter of math. If you have a very high percentage of funds being institutionally managed, and a great many institutions charge a lot of money for doing it and others charge a little, they're going to get very similar gross results but different net results. And I recommend to all of you reading John Bogle's written a couple of books in the last 5 years, and I can't give you the titles, but they're very good books, and anybody investing in funds should read those books before investing, or if you've already invested, you still should read the books, and it's all you need to know really about fund investing. So I would pick a broad index, but I wouldn't toss a chunk in at any one time. I would do it over a period of time, because the very nature of index funds is that you are saying, I think America's business is going to do reasonably well over a long period of time, but I don't know enough to pick the winners, and I don't know enough to pick the winning times. There's nothing wrong with that. I don't know enough to pick the winning times. Occasionally I think I know enough to pick a winner, but not very often. And I certainly can't pick winners by going down through the whole list and saying this is a winner and this isn't, and so on. So the important thing to do, if you have an overall feeling that business is a reasonable place to have your money over a long period of time, is to invest over a long period of time and not make any bet implicitly by putting a big chunk in at a given time. As to the criteria as to when you should or shouldn't, I don't think there are any great criteria on that. I don't think price-earnings ratio determines things. I don't think price-book ratios, price-sales ratios. I don't think there's no single metric I can give you, or that anyone else can give you, in my view, that will tell you this is a great time to buy stocks or not to buy stocks or anything of the sort. It just isn't that easy. That's why you go to an index fund, and that's why you buy over a period of time. It isn't that easy. You can't get it by reading a magazine. You can't get it by watching television. You'd love to have something that said, if PEs are 12 or below or some number you buy, and if they're 25 or above you sell. It doesn't work that way. It's a more complex business than that. It couldn't be that easy when you think about it. So if you are buying an index fund, you are protecting yourself against the fact that you don't know the answers to those questions, but that you think you can do well over time without knowing the answers to those questions, as long as you consciously recognize that fact. And I would, if you're a young person and you intend to save a portion of your income over time, I just say pick out a very broad index, and I would probably use the S&P 500, because I think if you start getting beyond that, you starting to think you should be in small caps this time and large caps that time, or this foreign side. And as soon as you do that, you're in a game you don't know. You're not equipped to play. In all candor, that would be my recommendation.